Picture this. You're 32 years old. You and your partner just walked out of the title office, the keys to your first real home clutched in your hand. You spent 18 months searching, bidding, getting outbid, and finally you got the perfect 3-bedroom in a decent neighborhood with good schools. You drained your savings account for that 20% down payment because you were responsible, you avoided the PMI, your parents called you, their voices bursting with pride saying you've made it. You're building equity now. It's your castle. That first weekend, you're at Home Depot planning the kitchen update, pricing out patio stones for the backyard. You feel this deep, settled sense of pride and stability. You're not throwing money away on rent anymore. You've finally acquired a real asset. But what if I told you that congratulatory handshake at closing was the start of a financial trap, not the end of a journey? But what if I told you that building equity is a slogan sold to you by a system that profits wildly from your belief in it? But what if I told you the math, the cold, hard, unfeeling math, says your primary residence isn't an asset that builds wealth, but a liability that systematically drains it, keeping you running on a treadmill just to maintain it? Behavior. This isn't about one bad mortgage. This is the middle-class housing trap. My name is Bobby, and I spend way too much time thinking about the financial scripts we're handed and why they keep so many smart, hardworking people from ever building real liquid wealth. If you're someone who feels house poor, your paycheck lands and immediately gets swallowed by the mortgage, the taxes, the endless upkeep, or if you truly believe your mortgage payment is forced savings, or if you've ever looked at your net worth on Mint or Personal Capital, seen that big Zillow number and felt rich, only to look at your bank account and feel cash poor, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we aren't talking about whether you should buy a house. We are talking about the catastrophic mistake of counting your primary residence as an investment asset. Or we're talking about the multi-trillion-dollar illusion sold as the American dream. Here's the thing about your home. Conventional wisdom. Your parents, your friends, the entire real estate industrial complex, they all tell you it's your greatest investment. Here, it's the cornerstone of wealth building. But that advice ignores a fundamental accounting truth. Your primary residence is a consumption item with a 30-year financing plan masquerading as an asset. It's a place to live, a wonderful, emotional, important place to live. But it is not, by definition, a vehicle for wealth creation. And to understand why we all believe it is, we have to go back to where the myth was born. Here, let me tell you a story. It's post-World War II America, the late 1940s. Millions of GIs are coming home. The government has a massive problem. How to house these families and stabilize the economy. The solution wasn't a wealth creation strategy, it was a social and economic policy. Enter the Veterans Administration loan and the Federal Housing Administration. Their mission was housing security and economic stimulus, make homeownership accessible with tiny 3% down payments and long-term government-backed mortgages. Put people in homes, put builders to work, get money flowing into local economies. The American dream was literally invented as a policy tool, and then the cascade began. If your banking changed, mortgages became safe, profitable products, banks could originate and sell recycling capital. A massive ecosystem sprang up. Real estate agents, home builders, mortgage brokers, all aligned on one message. Buying is always better than renting. Home equity became synonymous with savings. The 30-year mortgage became a normal life stage, not a financial instrument to be scrutinized. Then, in the late 20th century, home prices started to rise thanks to demographics, inflation, and easier credit. And this rise was retroactively cited as proof that the home was a genius investment. It completely ignored the costs and the context. We became a nation where the middle class's net worth is overwhelmingly concentrated in a single illiquid, costly-to-hold, undiversified asset that they must live in. The lesson isn't that homeownership is bad, it's that we conflated a social policy success with a personal finance strategy. This is what I call the foundation myth, the unshakable belief that a primary residence is by definition a productive financial asset. Now, you might be thinking, okay, Bobby, that's a nice history lesson, but how does that apply to my actual life in 2025? Well, look around you. This dynamic is everywhere. Let's take the upgrade trap. You buy a starter home for $400,000. 5 years later, Zillow says it's worth $550,000. You have a kid. You need more space. You tell yourself you've made $150,000, so you roll that profit into a down payment on an $800,000 home. Your mortgage just jumped by $2,000 a month. Here's the trap. You didn't realize $150,000. You locked it into another more expensive consumption item. You traded a smaller treadmill for a faster, more expensive one. Your property taxes, insurance, maintenance, and interest costs all just jumped. You've increased your fixed lifestyle costs permanently, demanding more future income just to stay afloat. And you're calling it moving up. Then there's the illusion of equity. You have $100,000 in home equity. You feel wealthy, but you can't spend it. You can't invest it. To access it, you have to sell or borrow against it and pay interest. That money is trapped, frozen in the drywall and shingles, funding your shelter, while it could be in the market compounding. It's dead capital. Quick other examples. Thinking you're diversified because you own a house and have a 401k, or using your home as a piggy bank for a kitchen renovation that adds zero to your quality of life but adds plenty to your debt. This is what we call the illiquidity illusion. You feel asset rich but are functionally cash poor, with your wealth frozen in the walls around you. Let's perform a brutal audit of this illusion. Sure, let's call this person Alex. Alex buys a $500,000 home with a 20% down payment. That's $100,000 down. He gets a 30-year mortgage at 6.5% on the remaining $400,000. We're going to analyze just the first 5 years. The starting number, what everyone sees, is simple. $500,000. Mortgage, $400,000. Net equity, $100,000. There it is. $100,000 in assets. But we're not done. Not even close. First, there's the financing siphon, the interest. Over the first 5 years of Alex's mortgage, he'll make total payments of about $122. Much of that actually builds equity? Only $37. The rest, $90,000. $90,000 paid directly to the bank for the privilege of using their money. That's our first cost. Running total $90,000. But that's the easy math. We all know interest is a cost. Now we have to subtract the ownership tax, property tax, insurance, maybe an HOA. Let's say property tax is 1%, so $5,000 a year. Homeowner's insurance, $1,200 a year. That's $800 a year just to hold the title. Over 5 years, that's $34,000. Rent paid to the government and insurance companies. The total is now $124,000. But we're not done. Then there's the degradation fund. The house decays, the roof ages. The furnace will fail the 1% of home value per year rule for maintenance is conservative. Let's use it. 1% of $500,000 is $5,000 a year. 5 years. That's another $25,000. New total, $149,000. And it gets worse. Then there's the darkest cost, the opportunity cost. That $100,000 down payment, the $31,000 in principal he did pay, the $25,000 he spent on maintenance, the capital wasn't idle. It was actively being destroyed because it wasn't invested elsewhere. Open payment, the down payment, the principal, the maintenance fund into a simple low-cost index fund averaging a conservative 7% annual return, he would have earned about $70,963 in growth over those same 5 years. That's forgone. Money, vanished potential. So let's add it up. The cash costs are $149,000. The opportunity cost is $70,963. But the total cost of owning this asset for 5 years is $219,000.60 That's not a typo. For Alex to simply break even after 5 years, not make a profit, just get back to zero, his $500,000 house must appreciate to $719,963. That's a 45% increase. That's about 7.6% annual appreciation every year for 5 years just to cover the costs of holding it. You didn't need your house to go up. You needed it to soar just to stand still. Think about that for a second. And we haven't even touched on the broader data. According to the Federal Reserve's 2022 Survey of Consumer Finances, the median net worth of a homeowner is $390.60 compared to just $10,400 for a renter. The housing industry uses this stat as a trump card, but it's correlation, not causation. It doesn't show the house created the wealth. A 2021 analysis by J.P. Morgan Asset Management, looking at data from 1947, found the average annual return for U.S. residential real estate was 4.6%. The S&P 500 over the same period? 10.5%. And before you say, but leverage, you're leveraging a 4.6% returning asset with 6.5% debt. Behavior. That's a negative carry trade. You're borrowing expensive money to buy a low-returning asset. Finally, a 2023 report from Harvard's Joint Center for Housing Studies found that 47% of homeowners aged 65 to 79 have less than $100,000 in non-housing wealth. Nearly half of older homeowners are house-rich, cash-poor. Their wealth is a monument they live in, not a fund that generates income. That's the equivalent of retiring with $1 million painting on your wall and a $20 bill in your pocket. This is where it gets really interesting. The costs aren't random. They form a self-reinforcing cycle. When you buy a home with a massive payment, you commit to that monthly cash outflow. Sure, that outflow forces you to prioritize job security and immediate cash flow above all else, above career risks, above starting a business, above going back to school. Here, the need for stability makes you risk-averse, which kills your ability to make the bold moves that actually build wealth. It's like being a hamster on a wheel that's inside a beautifully decorated cage. If you're running just to keep the cage. You can't get off the wheel because then you lose the cage. And here's what really gets me. The real estate financial complex relies on this behavior. They profit on you taking out a massive loan, origination fees, mortgage-backed securities. They depend on you constantly trading up. That's 6% commissions on ever larger sums. They literally budget for your maintenance. Home Depot, Lowe's, contractors, they all forecast based on home ownership rates. When you buy a modest, affordable home and aggressively invest the difference, you become a bad customer for them, but a great CFO for your own life. The system wants you focused on square footage and granite countertops because that hides the truth. You're locking up your capital in a low-return, high-cost vehicle. This isn't just bad math. This is a predatory wealth illusion sold as a patriotic virtue. Now, I can hear the objections already. Bobby, I have to live somewhere. Rent is throwing money away. And look, I get it. That seems so logical, but you're not throwing money away. You're purchasing flexibility and liquidity, but that wasted rent is often less than the non-equity building costs of ownership. The interest, the taxes, the insurance, the maintenance, the difference between rent and those costs can be invested in actual assets. You might also be thinking, what about the psychological value? The stability for my family? That is absolutely valid, but you have to price it. Is that stability worth requiring a 44% appreciation just to break even? Often the stability is an illusion. You're now anchored to one job market, one location, one massive liability. The problem isn't wanting a nice place to live. The problem is confusing that consumption with a high-performing investment. So what do you actually do with this information? How do you escape the trap? Let me give you something practical. Strategy number 1, the 5% rule. This is your instant buy versus rent litmus test. Take the value of a home you'd consider buying. Multiply it by 5%. That's the approximate annual cost of ownership, mortgage interest, property tax, insurance, maintenance, minus the tax benefits. Behavior why it works. It converts the fuzzy feeling of ownership into a hard annual rent equivalent. Here's how to implement it. First, look at a $600,000 home. Second, multiply. 600,000 times 0.05 equals $30,000 a year, or $2,500 a month. Third, can you rent a similar home for under $2,500 a month? Yes, you should seriously consider renting and investing the difference. Example, if the rule says $2,500 but rent is $1,900, you save $600 a month plus your entire down payment, which can now compound in the market. Your strategy number 2, the cap conserver mortgage. If you decide to buy a cheaper home than the bank says you can afford, aim for a total payment, principal, interest, taxes, insurance that is less than or equal to 25% of your take-home pay on a 15-year mortgage. Why it works. It forces true affordability, slashes the interest torture, and builds equity at a blinding speed, freeing up your cash flow much sooner. Behavior. It's the antidote to being house poor. How to implement: ignore the bank's pre-approval letter. Calculate 25% of your monthly take-home pay. Behavior: use a mortgage calculator to find the home price that fits a 15-year payment into that box. Strategy number 3, the asset-first allocation. Before you even think about buying, ensure your liquid investment portfolio, your brokerage and retirement accounts, is at least twice the size of your planned down payment. Why it works. It ensures you are already a serious investor before you take on the wealth-hampering load of a house. It prevents the all-your-eggs-in-one-house scenario. The biggest shift is psychological. You have to start asking, what is the minimum house I need to be happy, instead of what is the maximum house I can afford. You're not a successful 35-year-old with a $750,000 home and a $675,000 mortgage. You're a successful 35-year-old with a $250,000 investment portfolio and a $250,000 home with a $150,000 mortgage. Behavior. Here's what I want you to do this weekend. Run the 5% rule on your current home, or one you're looking at. Then, take your down payment amount and plug it into a compound interest calculator at 7% over 10 years. What you'll discover in that 5-minute exercise is the true, staggering price of the foundation myth. I want to leave you with one final thought. A home isn't really about investment. It's about shelter. It's about community and family and safety. We thought it could be both our castle and our stock portfolio, but the math shows that's a conflict of interest. Our grandparents bought homes for stability at a time when one income could cover it and prices were low relative to earnings. We traded that model for maximum square footage at maximum debt, betting on endless appreciation to bail us out. The people who actually thrive financially aren't the ones with the most expensive homes. They're the ones with the most optionality. Their wealth is liquid, diversified, and working for them 24/7. A behavior: you can't eat your equity, you can't dividend your shingles, but you can design a life where your shelter serves your life, not where your life serves your mortgage. That separation of purpose, home for living, investments for growing, is the most powerful financial decision you can make. You're not broken for wanting the white picket fence. You're human. This journey is unfair and it's hard because the myth is woven into our culture. But once you understand that your home is a liability on your personal balance sheet, you can stop asking it to be something it's not. You can make clear-eyed, powerful choices. If this video reframed how you see your largest asset, share it with one person who needs to hear it. Smash that like button if the math shocked you, and hit subscribe for more content that challenges how you think about money. Thanks for watching, and I'll see you in the next one.